Hello there everyone, in today's videos we're going to take a look at a management buyout, an MBO. Various ways that you can do an MBO. I'm going to just focus on one particular way and talk through some of the benefits, why I like this particular way. So, let's assume we have an individual here, Mr. X. And Mr. X is the sole director and shareholder of a trading company. Now, this trading company manufacturing widgets, he was the founder, he's been in the game for years, and he wants to get out. And he's got a top team of management. He's got three guys, Mr. A, Mr. B, and Mr. C, imaginatively titled. And they basically have negotiations with Mr. X to buy him out. He wants to retire, sail off into the sunset, they agree a price, few quid for the shares in the company, and these guys, the management of the company, will buy him out, hence MBO, management buyout. So, how are they going to do it? Well, typically, what would happen is this. So these guys, A, B, and C, would form a brand new company, so a limited company, what we call acquisition company. And they will go to a bank and say, can we have some funding, please? Because we'd like to buy the share capital of Tradeco off Mr. X. And the bank would normally say yes, but we're not going to lend the whole thing to you. We'd like to see a little bit of skin in the game. So typically these guys would put in a few quid themselves, mostly in the form of director's loan account, which they could then extract tax-free in the future. So these guys form a brand new company, lend some seed money, bit of equity, and then the bank says, yeah, very good. They'll fund the balance, goes into here. So this company is then flush with cash. It then acquires the shares. It buys the shares of Mr. X. So the trade company then becomes a 100% subsidiary of the acquiring company, the brand new company, with Messrs. A, B, and C as the director shareholders of this company, which then buys this. And they would also become directors of this company, which will now have a sole shareholder, that being the acquiring company. So then, going forward, this company makes a few quid, pays its corporation tax, and then the post-corporation tax profits would pass up to the top company, the acquiring co, in the form of dividends. Now, dividends landing here would be tax-free, because when a company receives dividends from its subsidiary, there's no corporation tax. So cash arrives from the subsidiary to the parent company, which is then used to pay down this bank loan and pay some dividends to these guys as well. So flow of funds is from the individuals to the company, from the bank to the company. Newco then pays off the departing shareholder, and then going forward, monies flow from existing Tradeco to Newco to the bank. Very good. So, then in a few years, assume this. Let's say in 5 years' time, Y PLC. So a large company comes to these guys and they say, look, we're interested in this business. Okay. So, because this is a company that owns the shares in this trading company, and it's owned this for more than 12 months, a capital gains tax relief called substantial shareholdings exemption, SSE, will apply, which basically means that this PLC, which hopefully will pay quite a lot of money to these guys to acquire this company, it'll land in this company tax-free. So acquiring company, you'd have thought as well at this point they'll have paid off their bank loan and everything else, but this company here can be offloaded by the acquiring company tax-free because of those SSE rules in several years down the line. So then you've got a company here, these three guys as the shareholders, with a load of cash in it. So this is one of the perks of doing it this way. For the future sale, you get this substantial shareholding exemption, no capital gains tax. So then you say, right, well, we've got a shell company, it's full of cash, three guys. What are we going to do then? Now, at that point, typically what you could do is say, well, depending on what would typically happen if you were sold a business and you've got a load of money, what are you going to do with it? Well, most of it you may choose to invest it. So you've already got it in a limited company. But the point is now, though, you've got 3 guys with one limited company with a load of money. And they may, at that point, I would suggest very likely that they may have different ideas on how to invest that money going forward. Some of them will want to leave it in the company. Some will want to get their hands on it for personal reasons. So at that point, what you can do is what we call a demerger. Essentially, we would set up, we'd split that company and set up 3 separate companies, A Co, B Co, and C Co. So there's various ways to do a demerger. So one of the ways to do it, you would essentially end up with each of the individual guys having their own company. So they're free to then do what they want with their respective companies, which has a third of the cash that was in the original company here. And they may want to leave it in a company, invest it. They may want to put it in a members' voluntary liquidation and get their hands on the cash personally. But the point is they're free to do whatever they want with no recourse to the others because they've done the demerger at that point. Okay, so just an overview there on a management buyout and one of the ways that you can do this. So if you like this video, please do subscribe, and as always, I'll see you soon.